Well, good afternoon and welcome. We're rolling in attendees here as we get started this afternoon. It's my pleasure to join you and to welcome you to our webinar on the Nebraska farm income situation and outlook. We're going to feature both a look at the latest Nebraska numbers, as well as a review of the latest outlook for the U.S. farm income situation. And I'm joined by Alejandro Plastina, who is the Director of the Rural and Farm Finance Policy Analysis Center at the University of Missouri. Alejandro, in fact, is a graduate, an alum of the University of Nebraska. So it's sort of at least remotely welcome back to Lincoln, or at least welcome back to a Nebraska audience and beyond. But Alejandro has a master's from Nebraska in statistics, along with his PhD in ag economics that he earned back here a little less than 20 years ago. Not to age either one of us, but we remember those days well. After his graduation, Alejandro worked in Washington, D.C. for the cotton sector for some time and spent 10 years on faculty at Iowa State University before recently accepting and moving to Missouri to serve as director of the Rural and Farm Finance Policy Analysis Center. So it's a pleasure for Alejandro to join us and continue the tradition that we've started with our colleagues at RAF. Nebraska and the Center for Ag Profitability collaborate with RAF on these state-level farm income estimates. And Alejandro, as director, is joining us for the first time representing RAF in this discussion. So we're going to talk about the U.S. farm income situation and outlook with information that Alejandro shares from RAF and from FAPRI, and I'll let him explain those acronyms and the discussion and the effort that happens there. And then I'll continue the discussion with some more detailed numbers in terms of what happens here at the Nebraska level before we have some common conversation and take some input from the audience. For our many attendees online, please consider any questions you have and submit them via the chat box, or more specifically, preferably through the Q&A function in your Zoom app. We will take those as we are able, and we'll certainly try and address questions here as we conclude today's webinar. But that's enough of a brief introduction, except to say, of course, this webinar is being recorded, as all of our webinars are. We have at the Center for Ag Profitability generally delivered a educational webinar every Thursday at noon or thereabouts, based on some adjustments to the schedule. And you can find past webinars on the archive on our website at cap.unl.edu. That's CAP for the Center for Ag Profitability. So cap.unl.edu, and you can find webinars, our archived webinars from the past. This one will be up there soon, and any of our upcoming webinars that are scheduled and confirmed at this point. So encourage you to look at that and consider other opportunities. But again, a privilege and gratitude to you for joining us today and for this conversation we're going to have about farm income. Alejandro, I turn it over to you and invite you to share your slides and begin your discussion.
Well, thank you very much, Brad. Can you hear me well?
It sounds fine.
All right. Thank you. I really appreciate this invitation. As Brad mentioned, I'm the director of RAF, the Rural and Farm Finance Policy Analysis Center. Just joined this team about 2 months ago, and this is the first round of Farm Income Outlook reports. So I'm thrilled to be sharing these results with Brad and with the attendees, but I will focus on the U.S. Farm Income Outlook mostly. Let's see, there we go. And I will be using FAPRI projections for the U.S. And FAPRI is the Food and Agricultural Policy Research Institute at the University of Missouri, and they have just turned 40 years of age as of a couple of weeks ago. So you can find their reports at fapri.missouri.edu. The Rural and Farm Finance Policy Analysis Center at the University of Missouri, the team that I direct, was launched as a critical to fill a critical gap in agricultural finance and policy analysis, and it focuses on helping decision makers understand how economic scenarios can impact individual states and geographic regions, and by providing objective analysis and data-driven insights to stakeholders in policy and industry. The center is supported by cooperative agreements with USDA Office of the Chief Economist, and through their funding, we produce the state farm income models, and we collaborate across states to provide state farm income outlooks and other reports. We're very pleased to be able to count with the University of Nebraska-Lincoln Center for Agricultural Profitability among our collaborators. We also collaborate with other land-grant universities like Kansas State University, University of Arkansas. We are working with Iowa State University, University of Minnesota, and the collaborations are expanding as we speak. And RAF is a sister organization to FAPRI, in the sense that we are both policy analysis centers funded by the Office of the Chief Economist. And of course, we are highly appreciative of their support. They're a little sister for now. We have just published 8 farm income outlook reports, including the one that Brad will be discussing after my presentation. And I want to encourage you to go ahead and visit ruralandfarmfinance.com, where you can not only download these reports, but also drill down on the data through an interactive data visualization tool. So you can create your own graphs, your own reports, and find your own insights at ruralandfarmfinance.com. Let's go straight to the U.S. farm income outlook. And the bottom line here is that in the short and medium term, FAPRI projects some pain for field crops because of lower prices, although some costs are going down, not all of them, and some of them remain high. So cash flow in field crops might be a challenge in the coming years. On the livestock sector, we have a mixed bag, but cattle is doing very well. There are limited supplies, high prices, and low, I would say, stable at low levels feed costs. And that's true for those who have access to feed, right? For those who have access to hay and to other feed. But cattle is in the best shape out of all the livestock sectors. Now, in terms of the aggregate, FAPRI is projecting lower U.S. net farm income in 2024 and 2025, and only a moderate recovery for 2026. FAPRI, of course, as any institution doing forecasts, relies on a number of assumptions. And those assumptions related to the policy variables are that things won't change in the foreseeable future because of the uncertainty regarding the policy variables going forward. But we have an election, a federal and a national election, and things might change. So these projections might change depending on what policy path is chosen by the new administration. So that's something to keep in mind. Let's go straight to the crop side, and let's start with U.S. corn first. So this table has a number of columns in black and 2 columns in red. And the black columns indicate the fonts in black indicate USDA numbers, and the ones in red, the fonts in red, indicate FAPRI projections. And these projections are from August 2024, while the USDA numbers are correspond to the October 2024 WASDE report. So there are a few differences between USDA and FAPRI numbers for 2024, 2025, but that's kind of minor compared, but they show the same trends. And for 2025, 26, we only have fab rate projections. So what do we see in this chart? Okay, let's focus on 2024. And we see that corn production is projected to go down, mostly because of lower area planted to corn. Demand is feed use is expected to be slightly higher, about stable. Ethanol use is expected to decline somewhat. Exports are projected to increase somewhat, but the ending stocks are expected to go up. And that, of course, is a bad signal for prices. And the market union average price for 2024 is projected at $4.10. And that's for both Fabry and USDA. And that's a decline, right, from what we've seen in 2023 and 2024. Now, since the international situation is of lower production outside of the US, right? And smaller trade, that's the key here. We're seeing smaller trade and overall no change in stocks. There's not much to expect in terms of higher corn prices for 2024 and not much for 2025 either. So going forward, Fabry projects more area planted to corn, higher production, and higher demand for corn, but prices not much higher than what they are projecting for 2024. So that's a bad start for our forecast, right? Let's move to wheat now. And while production is up due mainly to higher yields because the area planted went down in 2024. On the demand side, we see a slightly higher demand for wheat, but still ending stock, since the supply increased so much than the demand, so much more than the demand, ending stocks are projected higher, and that affects prices, of course. Projected prices are lower for 2024 than 2023. And going forward, since the overall demand is expected to be about stable in 2025 and production to go a little bit lower, then US prices for wheat are expected to go up, but remain below the 2023 levels. So not very promising either. Longer term Fabry price projections aren't really exciting. These are, kind of flat projections. There's not much additional sources of demand for these commodities, and the futures prices as of the day before yesterday are not much positive either. Those are in green in these charts. So corn and wheat prices are likely to remain subdued. Moving to soybeans, we can see that production has increased, or is forecast to increase substantially in 2024 with respect to the previous year, both because of higher area and higher yields, while on the demand side, Fabry is also projecting increased demand, substantially increased demand, particularly on the crush side and on the export sides. But given this huge crop, ending stocks are expected to go up too. And globally, we're seeing a much larger crop, 8 to 9% larger than previous year for 2024, with a 5% higher crush. So the stocks are also accumulating worldwide, and that puts a lot of downward pressure on prices. And here's a big difference between USDA price projections for 2024, 2025 as of $10.80 per bushel, while FAPRI projects $9.99 per bushel, much, much lower price point. Now, going forward, the stocks to use ratio at the world level is going up, is projected to go up by USDA. So that puts further downward pressure. Production in the US is not expected to go down, while the demand side is expected to remain strong. But still, ending stocks are likely to increase in 2025, and the average market price for next season is projected at 965, even lower than for 2024. So the FAPRI projections are supported by the November futures prices from CME as of the day before yesterday again. And we don't see much improvement either on the soybean product, meal, and oil. So on the cash receipt side, we are not expecting very positive news on the feed grains or oil seeds. In fact, U.S. cash receipts from crops are expected to go down by $32 billion, mainly because of lower feed grain, oil seed, and cotton receipts. Moving on to the cattle or livestock side, let's start with cattle. We've seen this long-term decline in beef cow herd, and this usually goes through long-term cycles. And the cycle has peaked in 2019, the most recent cycle, and the FAPRI is projecting that it will continue going down until 2026. So we have 2 more years of declining cow herds for the U.S. until we can rebuild those herds in the future. Now, in terms of prices, the fed steer prices, right now projected to range between around 186 for 2024 and $187 per hundredweight in 2025. Those are very strong prices, reflective of lower supplies or limited supplies. But that's the good news on the ag sector, that the cattle prices are strong and there's profitability in cattle production. But fed steers, those prices are also going up, and we are seeing a reduction in the margin between the two, the gross margin between the two. But still, we expect FAPRI expects cattle to remain profitable for a number of years. When we look at all cash receipts from livestock, they are up by 19 billion in 2024, mostly because of cattle, but eggs played a major role also, and along with dairy products with higher prices. But going forward, cattle remain strong in 2025, but poultry and eggs go down, dairy products go down, hogs remain kind of stable, and other livestock remain stable to declining in terms of cash receipts. So neither crops nor livestock, except for cattle, have very good news in the short term. The other positive piece of news besides cattle and prices of and profitability of cattle are that some production costs are declining from their peaks in 2022. So these are not historically low, but they are low compared to their peaks in 2022. So fertilizer prices, fuel prices are going down, and the FAPRI projects that variable costs will continue to go down in the short term and maybe for a couple of years, but they will remain far above pre-2022 levels. So the chart on the right actually illustrates that, and the major decline in costs projected for 2024 and 2025 has to do with lower fertilizer costs. But the other costs will decline more slowly, and not all costs are expected to decline. We have some of the costs not included in this chart are labor and land rents, for example, and labor costs and land rents are likely to adjust, but much more slowly than these other inputs. And although this chart is particularly for corn, it provides a good idea of how these variable costs are panning out for other crops. So Fabry projects a similar pattern for most crops. So when we aggregate across all crops, not just corn, but all crops, you see that in this chart, Fabry projects lower variable costs for all crops in the US for a number of years, mostly driven by reductions in fertilizer and fuel and electricity costs, and to some smaller extent to pesticides. Seed costs are expected to remain high or even go up a little bit. Compared to 2022, 2023, these numbers are lower, but they are higher than in 2021 and 2020 and in previous years. So cash flowing will be, an important concern for crop producers going forward. On the cost side of livestock production, Fabry projects a continued decline in feed costs, but a stable, first of all, an increase for 2024, but a stable cost of purchased livestock going forward. So bad news for crop producers are not so bad good news for livestock producers. That's always been the case. It's a seesaw. And on the feed side, that's also good news for cattle producers and livestock producers in general. But of course, bad news for crop producers. When we aggregate across both the crop and livestock sectors, this is a picture of farm net income. And we are showing this in two ways, in accrual terms and in cash income, net cash income. And the difference between the two lines is mostly changing inventories and non-cash costs like depreciation. And what we see is that net farm income clearly peaked in 2022. It declined in 2023. 2024 is forecast to be a second straight year of declining income. And going forward, 2025 will be the third straight year of declining net farm income before a moderate recovery in 2026. So not very good news for the ag sector in general. And when we look at the components of that change in net farm income, in 2024, farm receipts, in 2024 and 2025, farm receipts will be the main driver of this change in net farm income, lower farm receipts, and this includes, of course, crops, livestock, and farm revenue. $16 billion lower farm receipts in 2024 than in 2023, and $18 billion lower in 2025 than in 2024. Total expenses are it's projected to offset partially that decline in farm receipts because we are seeing a decline in total expenses, but not nearly enough to fully offset the decline in farm receipts. Government payments are not contributing much to this entire picture, but they would be about $1.7 billion lower in 2024 than in 2023. And in terms of net farm income, in accrual terms, FAPRI expects a 9 billion decline in 2024 and an 8.4 billion decline going forward into 2025. When we take into account the expected inflation as using the projected GDP deflator for the years to come and the observed GDP deflator for past years, FAPRI projects that, the numbers projected by FAPRI look even worse because looking from 2022 through 2024, through 2025, the total decline from the peak would be $67 billion. That's a 35% reduction in net farm income in real terms. And when we look at 2025 onwards, the real net farm income or inflation adjusted net farm income, of course, will be much lower. It doesn't really recover to the level of 2024, but it will remain higher than real net farm income in 2015 through 2020. But that's a tremendous loss of net farm income in just a short period. As I mentioned at the beginning, all these projections are based on certain assumptions, and the most volatile and uncertain assumptions right now are on the policy side. So can we expect a new farm bill after the November election or a re-extension of the 2018 Farm Bill that will affect the Farm Bill payments, of course. And we know that the House committee passed a bill increasing statutory reference price and marketing loan rates, but we don't know whether that will go through the Senate or the Senate will come up with a different plan. Is there room for an assistance package before the next Farm Bill? There are talks about that, and that could particularly help crop producers go through this downturn more smoothly. We know that USDA, EPA, and other agencies are working on the clean fuel tax credit, and we are waiting on that regulation to be finalized to actually try to develop extension and education programs for farmers to see how and whether they can benefit from those tax credits. But right now, there's no certainty about that. And we don't know the agenda of the new administration, whether there will be extended tax cuts, whether there will be extensive tariffs, their levels, and the regulatory agenda. So that's something very important to take into account. The uncertainty regarding these projections is very high. And with that, I want to thank the audience. I want to thank Brad and the Center for Farm Profitability at UNL. And please take a chance to scan this QR code so you can subscribe to our updates, the RAF updates, and we'll send you emails with our new publications. And with that, thanks again. I will stop sharing. Look forward to our discussion.
Alejandro, thank you very much. We have some questions I know coming in. We are going to hold them and sort of get to a whole Q&A session. So know that we are getting your questions and we'll take a look at them here and get to them when we get to that section. I want to spend some time here to try and tell the story about Nebraska as well. Make sure things are copying here okay. So I want to carry Alejandro's story about the U.S. Farm income outlook to a Nebraska-specific analysis as prepared in the material that RAF and Nebraska Center for Ag Profitability collaborate on. If we think about the issues and the challenges that are facing agriculture today, there's clearly some concern about prices, and more specifically on the crop side than the livestock side. There are concerns about production costs, concerns about maybe the stickiness of high production costs, and thus combined concerns about some operating margins and some cash flow likelihood in the year ahead. We can take a look at the farm income safety net and talk about where it fits currently, which is relatively small, but where it might grow in the future years as well. And that leaves us with the management questions that we might finish with, and even sort of referenced by one or two of the questions. What does this really mean for decisions in the months and years ahead? Well, if you look at the broad measure of net farm income, Nebraska net farm income in 2024 is down. What we see here is a chart that projects 23, 24, and 25. 23 was actually a record, 9.2 billion in Nebraska. We did not project that record last spring when we were making projections in for 23, but the official numbers from USDA's Economic Research Service came out in February, and those projected a record here for net farm income. Official estimates from ERS for 2023 around 9.2. So 2024 is a sharp drop from 2023, and that's the pain we're feeling now, certainly. But it is still relatively strong in terms of long run scenarios here. If you take just the 24 number there at the end, a drop to about 7.7 billion. In real terms, looking back over the last 50 plus years, in real terms, that's much higher than the average of the last 10 years. It is, in fact, the fifth highest on record. So even though it feels sharp and it feels painful, and we're seeing that sentiment across the state, it is still relatively strong by where we've been. Now, the drivers behind that, if we look at crop and livestock receipts, remind us of this sort of tale of two cities. Well, maybe it's a tale of two farms, or it's the farm and the ranch, maybe more specifically even. Crop receipts have struggled, and crop receipts are down year over year here, and looking like they will be down further into our projection for 25 to come. Livestock receipts are much stronger. And in Nebraska, livestock receipts fundamentally means cattle receipts, because while all sectors contribute here, the cattle and calf receipts amount to about 90% of total livestock receipts in the state. So receipts are strong for on the livestock side, specifically the cattle side, and that helps to offset the declining receipts that we've seen on the crop side of the ledger. Now, that may be the income side, but the production side is also a challenge. And if we look at total production expenses here, intermediate product expenses are generally those purchased items. That includes the farm level inputs like feed and livestock purchases. It also includes the manufactured inputs like chemicals and fertilizer and so forth. So fundamentally, if we think about these categories here, production expenses, as Alejandro noted nationally, are equally high and challenging here in Nebraska. And in fact, they are at record levels projected here for 2024 before we get to the last year in the chart, which is also the projection looking ahead to 2025. Only in the coming year does it look like there's any sort of beginning of relief here in terms of what production expenses look like for the state. Now, if I divide those out just a bit more, the farm origin input expenses, that is the purchased feed, purchased livestock, and effectively the seed cost component that is attributed to the seed production sector in the agricultural sector. Well, it's really farm origin inputs that are the highest and substantially the highest. And Alejandro already noted We're seeing relief on the purchase feed side. Every dollar that the crop sector loses and laments over is almost a dollar that the livestock sector enjoys and benefits and reaps rewards of lower feed costs. And so on the farm margin input side, costs are up dramatically. It's not so much the feed in aggregate, it's the purchased livestock that have really driven that cost up dramatically for producers. Other inputs in there as well. Manufactured inputs are up. Other input expenses are up. Other overhead, labor is up as well. Or no, rather, other overhead is up. That's depreciation and capital expenditures. Generally, we see across the board increases in expenses over the last decade, and we see very little movement to start to bring those down, at least in line with declining receipts. One other component here to think about the contribution to the farm income bottom line is where we are with government program payments. And if we track government program payments here over roughly the last 25 years, we see a rather dramatic shift in the last decade. If we go back to 2015, commodity program payments were an important part of the farm program portfolio and an important part of the bottom line for producers. We were in the neighborhood of $500 to $800 million a year in commodity program payments from the ARC program or the PLC program. Those payments have, for all practical purposes, disappeared as higher prices for our program commodities meant that those programs didn't pay, except in maybe some extreme production loss scenarios for the ARC program. Instead, what really took over the portfolio here of farm program payments are the supplemental or disaster assistance payments, generally that came from a small set of standing disaster assistance programs, but more so an ad hoc delivery of legislative or administrative relief for ag producers. And that relief started in 2018 and 2019 with some substantial payments for trade assistance. Alejandro mentioned some of the policy uncertainty ahead. Well, if we go back to 2018 and 2019, we were dealing with the policy uncertainty of a trade conflict, and that resulted in some losses of export opportunities for U.S. agriculture and Nebraska ag specifically. And some of those losses were offset by substantial assistance payments from USDA. By 2020, we added in dramatic payments for COVID relief, some of that from USDA, some of that from other agencies like the Small Business Administration, but fundamentally a big portfolio of ad hoc relief that added billions nationally and added even about $2 billion in the state of Nebraska in terms of payments to producers. And so it sort of completely dwarfed the rest of the safety net put together. Now, in 2024, you will note a very slight return of commodity program payments, at least as it shows up on the graph. The RAF estimates of commodity program payments paid to producers in Nebraska in 2024 had projected, as of earlier this fall, potential PLC payments, potential ARC payments that in total would be around $55 million on average, according, based on the projections. Well, we now know as of earlier this week officially how many dollars USDA's Farm Service Agency is sending out the door. And while there were no PLC payments in Nebraska, there were substantial ARC payments, and the total was about $57 million. So let's take that as a win, even if the numbers or the categories aren't quite right, but a projection of 55 that becomes a final total of 57 is pretty close. Well, it's still small relative to where we've been with commodity program payments earlier in the past, over the last decade, but it is a contribution to cash flow and to the bottom line here at the present time. If you look ahead, if we really project further declines in commodity prices and we project further declines in farm income, it's not surprising that we project increases in commodity program payments. And there could well be 600 to 700 million plus in farm program payments in 25 that would be based on the results of the 24 crop year. We might project further payments beyond that. That assumes further farm legislation, whether it's a new farm bill or an extension of some of the existing legislation. One last item to note there in that graph on farm program payments, the green bar is conservation, and conservation has steadily grown and generally ends up in the neighborhood of 140 to 150 million a year in program payments to Nebraska producers. That's a substantial amount of CRP, but it's also EQIP and CSP and some of the other smaller programs. So the farm program in general, farm program payments from USDA to Nebraska producers have been declining in recent years, but they are still substantial. And one of the questions is where they go from here. And another question would be where we stand relative to sort of standing legislated farm programs versus the ad hoc assistance that we've seen delivered time and again in recent years. Now, if you sum all that up for 2024, we're down sharply from farm income in 2023, down to about 7.7 billion from what was 9.3 billion net farm income in 2023. It was a record. So 7.7 isn't as bad as it sounds, given that it's down, 1.5 billion or more from the previous year. But there are some sharp changes here. Crop receipts are down substantially, as noted. Livestock receipts are up. Crop insurance indemnities are down. One of the factors that did drive income a little bit higher in 23 were some above expected levels of crop insurance indemnities. As projected currently for 2024, they are down, although ultimately we'll find out next August how many total indemnities were really paid here in 2024. Production expenses are still higher, which means it's pulling down on farm income, and government payments roughly flat year over year. Everything else rounds out there, and we end up with the change in income for 2024. Compare that to the year ahead. It's an early look at 2025, so there's quite a few caveats and uncertainties here. But 2025 farm income, at least at present, may be relatively stable compared to 2024. Further declines in crop receipts, more than offset by continued increases in livestock receipts, as long as cattle prices stay ahead of inventory changes. Some crop insurance indemnities balance out. Production expenses that, because production expenses look like they will begin to back up in 2025, that adds to the bottom line. And then ultimately we see a bottom line around 7.4 billion. Down sharply from 24. 24 was down sharp. 24 is down sharply from 23. 25 is down gradually or modestly from 24. They point to a weaker economy and the sort of growing concern and sentiment that we've seen, but they are also still indicators of what has been a fairly strong Nebraska ag economy. Now, if you want to just make a projection here, this is a bit of a mea culpa, if you will. Our projections are not always accurate. We recognize that. The projections are fundamentally about the averages of, or the means of, a big stochastic process where you might project highs and lows, and over 500 or so simulated draws, you end up with an average projection. And thus the average projection always tends to look fairly straight, or fairly stable going over the long run. But if we look backwards at what we had projected for 2023, just this spring, we had projected a farm income number for 23 around $7.2 billion, which was a recovery and a much higher level than what we had actually seen in 2022. Nationally, the U.S. set a farm income record in 21, only to set it again in 2022 before dropping sharply in 23 and again in 24. In Nebraska, we set a record in 21, but then fell back sharply in 2022 because of drought problems and production losses that couldn't be made up for with higher prices. We rebounded in 2023. We had projected a fairly sizable rebound to about 7.2 billion. USDA's final estimate for 2023 actually came in dramatically higher. And part of the question and part of the challenge maybe to explain that is there are certain categories that made some big jumps. Crop insurance, total crop insurance indemnities in 23 were over $500 million more than what we had initially projected last spring. And so perhaps there were bigger payments, and some of that's 22 that got paid in 23. Some of that's payments later in the year in 23 that simply exceeded expectations. Feed costs were down sharply with drops in commodity prices. Feed costs were down over $1 billion in 23 compared to 22. But one of the categories that maybe surprised us, or at least was finally documented in the data, was poultry. The poultry industry in Nebraska has grown dramatically. And thus I have some data that actually point back to 2017, because we've been making, USDA, I should say, has been making some adjustments in the farm income numbers all the way back to 2017. Every time they run a new US Census of Agriculture, they get more insightful data in the year, and thus look back in time and go back and retrofit or correct some of their existing data. So the farm income, the Census of Agriculture in 2022 helped confirm some new numbers that they then went back and adjusted their previous estimates from 21, 20, 19, 18, all the way back to the previous census year of 2017. One of the adjustments that was made in those numbers over time is the growth of the poultry sector in Nebraska. The big numbers in the poultry sector historically were just eggs, and suddenly we found broilers. Well, we know where those broilers are at, and the growth of the Costco industry in Nebraska with the processing plant and the production operations. Well, those broilers add more than $400 million to the bottom line in 2023, just in poultry. And so part of that adjustment is maybe catching up with some surprises. Part of that adjustment is making some numbers fit the reality of what we really measure in the census. So there's some reality in here, and some surprises, but also some checking against some existing data. Well, all of that to say, our projection ahead, we project lower income in 24 relative to 23. Our fall projection is higher for both than it was back in the spring, but it's still going to be a challenge here, and a look ahead here at some challenges for producers. If we point those out a little bit to the longer run, and the projections that RAF has produced run through the next decade. So we have numbers here that go through 2033. These are projections. And as you might expect with projections, after you come off of the current peak in 23 and start to back up, we're heading toward a longer run average that tends to retreat towards a long run mean. So we come off of the record in 23, we drop sharply in 24 and 25, rebound potentially in 26 and 7 and 8, and then gradually trend towards a longer run average. And the thing that drives that, well, crop receipts might recover a bit, but they look relatively flat. That is a little bit lower prices or stable prices multiplied by the gradual increase in productivity year over year. Crop receipts might flatten out. Livestock receipts still look stronger through about 26 or 27 or 28 before they begin to fall back. And that's when cattle prices begin to recognize the growing inventory, which we should say the presumed or projected growth in inventory that leads to more marketings, that leads to lower prices and ultimately lower receipts. If we look on the expense side of the ledger too, we begin to think that expenses start backing up, particularly on the farm origin side, but that's predominantly feed and purchased livestock. If we look for manufactured inputs and we're thinking about the cost of fuel and fertilizer and chemicals, it looks pretty flat, which is to say the projections don't really show us a reason to expect a major adjustment or a major shock to those going forward. And the same for farm program payments. We may see some substantial increases in commodity program payments in the next few years to marry against the declining commodity prices. But part of those are in the formula for the ARC program and the PLC program that's tied to a moving average. And thus payments that grow as prices fall relative to the moving average will eventually fall again as the moving average falls too. All of this presumes current programs going forward, so nothing is promised here, but that's just a projection of where we would go with existing programs in place. Which leaves us to sum up the challenges and some of the issues we have before us. Lower crop prices are definitely challenging current receipts and cash flow. Livestock receipts help on aggregate, but obviously it may be a different producer that's concentrated in crops versus concentrated in cattle. And so on aggregate, that helps to balance the situation, but it certainly means that we have some mixed results for producers across the state. The safety net matters, and it's becoming more important. With prices dropping, we're getting to levels where commodity program support goes from virtually nothing to 57 million this calendar year to maybe hundreds of millions of dollars in the next few years. So it matters. Well, it doesn't completely offset the decline, but it does help manage some of the risk. It's a reminder that the insurance is also an important part of that safety net. Insurance premiums and insurance indemnities don't count on that farm program portfolio, but certainly they are a key part of the federal farm income safety net. And then we have the uncertainty about disaster assistance. We have existing programs, we have some current disaster assistance programs announced, and we have some of the speculation about potential disaster assistance programs yet to come after the election. And so what we have or how much support might be there remains to be seen. And then, of course, that means that the management question is probably what it always is. As we deal with declining receipts, as we deal with declines in prices, on the crop side particularly, we've got to deal with tightening margins and focusing on profitability. The bottom line margin is much more critical than the yield line alone or the price line alone or the revenue line in total. Focusing on margin is going to be a critical part of success for producers in the coming year. So with that, as a short summary, let me stop and invite Alejandro back on the camera. And let's dig into some of our questions that we've been adding up here while we've been talking. First one, Alejandro, that we got in early was relative to a slide you were talking about, I believe on corn, but it was fundamentally a question, what assumptions or what expectations do you see that is affecting potential ethanol use of the corn crop? And why are projections looking like they go down for 25, 26, and maybe a longer run scenario of what you envision?
So FAPRI is projecting lower oil prices for 2025 and a little bit higher, but still lower than in oil prices than in 2024 for 2026. So this decline in oil prices affects the profitability of the ethanol industry, and that will reduce or keep the demand for corn from the ethanol industry kind of limited. And on top of that, the existing capacity is being used close to the capacity, the maximum capacity level. So unless there are new investments in new capacity that might come in into the production system over the next few years, especially if the clean fuel tax credits actually materialize, that could actually increase the demand for corn from the ethanol industry, but there will be a lag. There are some conversations about expanding existing capacity, but not all the existing talks or the existing plans will be implemented, and those that will be implemented might operate at less than capacity, less than maximum capacity, that is. So with lower oil prices and no new sources of demand for ethanol, and competition in ethanol production with other feedstocks, there's not much to expect on higher demand for corn from the ethanol industry.
Alejandro, if I could extend that further into maybe more speculation, but the long run projections that you and colleagues at FAPRI have done don't assume a market that hasn't happened yet, right?
Exactly, exactly.
But the potential that agriculture talks about for renewable diesel and the potential growth for soybean oil, if it's allowed, and all kinds of questions, as well as the potential growth for corn, for ethanol, for sustainable aviation fuel. There's been a lot of talk about those driving major market moves if they happen.
Exactly.
Your projections, the projections from FAPRI don't assume the stuff that hasn't happened yet, right? So that
Exactly.
helps
Yes.
clarify that.
Thank you for clarifying that. Yes, the projections that I showed today are based on FAPRI's publication, and FAPRI projects lower oil prices. With lower oil prices, there will be less profitability for ethanol, and that's what's reflected in the tables I shared with the audience today. But on the extending that, as you said, extended the analysis to what could happen in the future beyond what's shown in these graphs. The clean fuel tax credits could be something that changed the dynamics in the ethanol sector, but we are not sure of how that will pan out. And if it pans out, how long it will take to actually be reflected in higher demand for corn.
Mhm. Uh,
Thanks.
Another question, or even a couple questions that look like they could be married here together. As I noted towards the end, the picture for crop producers is very different than the picture for livestock producers. Nebraska is one of those diversified states where we actually have more livestock receipts than we have crop receipts. By the time you back out purchased inputs like feed and livestock, the crop sector is still a little bit bigger than the livestock sector in terms of net receipts. But we're diversified. Well, but that's the state as a whole. That doesn't mean every producer is diversified. So
Right.
so the picture for crop producers is different than the picture for livestock producers, or specifically cattle producers. What does the picture really look like for crop producers? And relative to the related question, what does that mean for farmers' decisions on inputs for the 25 crop, particularly seed, fertilizer, crop protection, et cetera?
Yeah.
You have some projections of what expenditures look like, but what would you say that means for producer decision making?
So looking at the big picture of cash receipts for from crops, we are talking an 11-12% decline projected for 2024 in terms of cash receipts, and another 4 to 5% decline for 2025 in cash receipts. Now, yes, there will be, or there's a projection of lower costs, but we are talking much smaller declines in costs, 2-3%. So the margins, the profit margins in crop production will tighten even more as we go forward. What that means for crop producers is that cash flowing will become harder as we go into 2025. I expect some erosion of liquidity, working capital, and what steps can be taken at this stage. Well, some of the fertilizer might have already been purchased, right? and some inputs already purchased. Also, what can be done for in preparation of the next crop year, thinking about how to cash flow the operation. I think that's critical. Revisiting all the cost structure, maybe having a good conversation with an agronomist friend about what can be done to reduce costs without hurting yields too much. Revisiting cash rents or leasing agreements, making sure that they can be cash flowed properly, and thinking that there might be lower interest rates in the horizon to help farmers cash flow their operations, but it might take a while to get those lower interest rates. So planning ahead and visiting with an agronomist, again, as I said, and why not a financial, a tax specialist, someone who can help move things around so that this downturn can be reflected in the tax income tax payments properly, right? Basically rolling out these lower receipts over a number of years.
You bet. That outlook ahead, and you're right, it points to some major decisions that producers have to make. Some of the input decisions are already happening now, but everything from input decisions to crop mix to a bigger focus on risk management. It is not just about production. It is about managing production risk, price risk, financial risk, and that's understanding sort of the whole of the safety net. What role is there for commodity programs that may provide more support than they have in the past few years? What role is there certainly for crop insurance, or on the livestock side for the livestock insurance products? Those are all going to be some important questions for producers as we look forward here to the coming year. So with that, we have reached our time, and I want to respect everybody's afternoon here. But I want to thank Alejandro for joining us. Thank you for participating today and being part of our presentation and discussion of the farm income situation outlook, but also more broadly, thank you for the continued collaboration and the opportunity here at the Center for Ag Profitability at UNL, for the opportunity for us to collaborate with you at the Rural and Farm Finance Policy Analysis Center at the University of Missouri. It's a great opportunity to broaden the reach of this important policy research and to carry it locally, where we do some farm income analysis and some policy analysis work here in the state. So we appreciate the collaboration. We appreciate the insight you've provided, and thank you for the time you've given us today.
Thank you. Thank you very much, Brad.
So as we close, we thank you as well for those that participated and those that have taken time today to be part of this webinar. As always, as you leave the webinar, you will be asked or should be asked for your perspective and some feedback. We appreciate that, and we particularly appreciate any thoughts you have about what we can do and what we can continue to produce to be helpful to you and to Nebraska agriculture in general. The Center for Ag Profitability here at UNL continues its webinar series with more to come. Look on the website for a schedule of what's ahead. And as always, you can also find an archived copy of this and other webinars on the website as well. So we thank you for the time. We wish you well and look forward to visiting with you again sometime soon.